They say global finance speaks in charts, in carefully worded forecasts, in the calm authority of central bank podiums. But beneath all that, in the places where markets breathe in silence, there is another language older, colder, spoken only by institutions that cannot afford to say what they truly fear. It is the language of funding. Not funding as the textbooks describe it, not the comfortable notion of deposits and lending, but something far sharper, more fragile, and more brutally honest. In the dead hours of the morning, when traders refresh their screens for the 50th time, when liquidity turns thin enough for doubt to slip through, you can hear it. A whisper, a tiny shift in price that shouldn't matter, but somehow does. A cross-currency basis spread leaning a little too far. A dollar swap line lighting up with restless inquiry. A bank in Singapore bidding just slightly above normal for overnight dollars. Not enough to cause alarm, but enough that someone watching closely might wonder, why now? Most people assume banks chase dollars because the world is priced in them, because trade runs through them, because the U.S. economy anchors them. That's the story in the daylight, a story built for press releases and policy speeches. But the real story lives in the shadows of balance sheets that span continents, in the quiet math of liabilities that cannot wait until morning. Global banks chase dollars not because they want to, but because they have to. Because the structure of international finance has been built on a foundation that rewards compliance and punishes hesitation. A foundation that demands dollars even in places where the dollar is never spoken aloud. If you pay attention to moments of global stress 2008, 2011, 2015, 2020, you'll notice something strange. The first sign of panic rarely appears in stock markets, bond yields, or even commodities. It appears in the dollar, not the dollar index on CNBC, not the flashy headlines, but the invisible mechanics behind it, the scramble for dollar funding. A scramble that begins long before anyone calls it a crisis. A scramble that global banks feel like a tightening around the ribcage, a pressure creeping in from offshore positions they built during calmer seasons, and now cannot unwind. There's a moment, just before these funding stresses go public, when insiders can sense the shift. Order books thin, swap spreads widen. Collateral quality becomes more than a technical detail, it becomes a survival question. And at the center of this quiet storm sits the same gravitational force every time: the structural demand for dollars outside the United States. A demand nobody can fully measure, nobody can fully control, and yet everybody depends on. So, what is this hidden demand? To understand it, we need to forget the image of a local bank taking deposits and making loans. Instead, picture a massive, interconnected web of international banks, often called the Eurodollar system. These banks, which operate outside of U.S. regulations, create and lend dollars all over the world. A Japanese bank might lend dollars to a German corporation, which then uses those dollars to pay a supplier in Brazil. None of this involves a bank branch in New York. It's a parallel dollar universe. For decades, this system worked beautifully. It fueled global trade, investment, and growth. Banks could create dollar liabilities promises to pay dollars in the future, and were confident they could always find the dollars to meet those promises. They would fund long-term dollar assets, like loans, with short-term dollar liabilities, like commercial paper or interbank loans. It was profitable, efficient, and everyone was doing it. But there's a fundamental flaw. These non-U.S. banks are creating dollar promises, but they don't have a direct line to the ultimate source of dollars, the U.S. Federal Reserve. Their access is indirect, through correspondent banks or swap markets. When everything is calm, this isn't a problem. Liquidity is abundant. But when a shock hits the system, fear spreads. Lenders start to hesitate. They ask, can this European bank really get the dollars it owes me? Suddenly, everyone wants their dollars back now. The short-term funding that was so easy to get yesterday disappears. This is what we call a funding squeeze. The international bank has plenty of assets loans that are perfectly good, but those assets are long-term. Its liabilities, however, are due immediately. This mismatch is the core of the problem. The bank is solvent, but it's not liquid. It is like owning a portfolio of real estate, but not having enough cash to pay your electric bill. This is when the desperate chase for dollars begins. The bank can't just walk up to the Fed, so it has to pay a premium in the open market. This is where we see the signals. The FX swap market is a key battleground. A European bank might have plenty of euros, but it needs dollars. It enters into a swap, essentially trading its euros for dollars for a short period, with an agreement to swap them back later. When many banks are desperate for dollars, the cost of this swap skyrockets. The price to borrow dollars using another currency goes way up. This is the cross-currency basis spread I mentioned earlier. When it blows out, it's a giant, flashing red light that screams dollar shortage. It's the market's way of saying that the promises made in calm times are being tested by fear. This isn't just a theoretical problem. During the 2008 crisis, the dollar funding markets for European banks completely froze. These banks held trillions in dollar-denominated assets, much of it related to the U.S. housing market, but they couldn't get the short-term dollar loans to fund them. This was a primary driver of the crisis spreading globally. The system was choking. In response, the Federal Reserve had to open up unprecedented emergency swap lines with other central banks, essentially becoming the dollar lender of last resort to the entire world. The same thing happened in March 2020. As the pandemic shut down the global economy, the dollar funding market seized up again. It wasn't about the virus itself. It was about the uncertainty it created. Every corporation, every fund, every bank wanted to hold dollars as a safety measure. This global dash for cash created a massive shortage outside the U.S. Once again, basis spreads blew out. And once again, the Fed had to step in with massive liquidity operations and expanded swap lines to prevent a complete meltdown of the international financial system. The key takeaway is this: the global financial system is built on a structural short position in the U.S. dollar. Non-U.S. entities owe more short-term dollars than they can reliably access without a perfectly functioning market. This makes the system inherently fragile. It works 99% of the time, but during that 1% of panic, it breaks down catastrophically. This addiction to dollar funding creates a doom loop. To attract dollars, international banks and corporations issue dollar-denominated debt. This increases the total amount of dollar liabilities outside the U.S. When the next period of stress arrives, the scramble for dollars is even bigger, because the pool of debt that needs to be rolled over is larger. The system's addiction grows stronger with each cycle. So, where do we look for the next tremor? We don't look at the stock market. We look at the plumbing. We watch the FRA spread, a measure of stress in interbank lending. We watch the price of commercial paper. We watch the cross-currency basis swaps for the yen, the euro, and the pound. These are not front-page news. They are obscure indicators, hidden deep within the financial architecture. But they are the canaries in the coal mine. They tell the real story of fear and liquidity long before the headlines catch on. The truth is simple, but unsettling. The global financial system is addicted to dollar funding. And like any addiction, the symptoms appear long before the collapse. A small imbalance, a slightly elevated premium, a bid that shouldn't be there, a silence on a trading desk that should be buzzing with liquidity. If you know how to read these early signals, you can see the world tightening before the world even realizes something is wrong. This isn't about predicting the exact day of the next crisis. It's about understanding the underlying fragility. It's about recognizing that the calm we see on the surface is maintained by a frantic, and often desperate, chase for dollars happening every single day in the shadows. The next shock won't begin with a bang, but with a whisper in the funding markets. A whisper that gets louder and louder until it can no longer be ignored. Once you understand how global banks pursue dollar funding, you'll understand the part of the system no one ever talks about, and why the next shock will begin long before anyone admits it. To understand why global banks chase dollar funding with a desperation that feels almost structural, you have to step far back into the architecture of a world that never consciously chose the dollar, but ended up built entirely around it. This story doesn't begin in New York or Washington. It begins offshore, in the cracks between national banking regulations, in the shadows where financial systems accidentally fused into something larger than any single country ever intended. Long before we spoke openly about globalization, before digital markets turned capital into an organism that never sleeps, there was a quieter transition happening inside the plumbing of international finance. And it all started with the simple question: when nations trade beyond their borders, what currency do they trust? The 1950s offered an early clue. Post-war Europe was rebuilding, Asia was industrializing, and global trade demanded a unit of account robust enough to anchor contracts between countries that barely trusted each other. The dollar, backed by American industrial dominance and convertibility to gold, offered that solution. But the real turning point wasn't driven by central banks. It came from private banks scattered across Europe in London, Paris, and Zurich when they discovered they could hold dollar deposits entirely outside the United States. Think about that for a second. No American regulation, no reserve requirements, no restrictions, just offshore dollar balances, which later became known as Eurodollars, circulating in a parallel universe that the Federal Reserve did not control. From that moment on, a dual dollar system began to emerge, not by design, but by accident. You had onshore dollars, governed by the Fed, and offshore dollars, created by private banks responding to the growing needs of international commerce. And as global trade expanded, so did the incentive to finance it in dollars. This wasn't because the United States demanded it, but because the global banking machinery found it incredibly profitable and efficient. A dollar borrowed in London could fund a project in Brazil, settle a shipment in Singapore, or hedge a position in Frankfurt. The geography didn't matter. The infrastructure did. By the 1970s, the Bretton Woods system collapsed, and the dollar's convertibility to gold was dissolved. Logically, the dollar should have lost its anchor, but instead, it gained something far more powerful than gold. It gained momentum. Once a complex system decides what it trusts, it very rarely rewrites the rules. The dollar had already become the backbone of global liabilities, the denominator of energy markets, the settlement layer for financial institutions, and the lifeline for emerging markets seeking stability against their own volatile currencies. Then, when OPEC decided to price oil exclusively in dollars, it completed the loop. Suddenly, every nation seeking energy had to seek dollars first. Banks, in turn, positioned themselves to supply those dollars, creating the first layer of what would become a perpetual global funding race. But the deeper shift came from the world of leveraged finance. As global banks expanded across continents in the 1980s and 1990 seconds, they discovered a critical truth. Their international portfolios, their loans, securities, and derivatives required dollar funding even if the underlying clients weren't American. Let's break that down. A corporation in South Korea borrowing to expand its operations might owe its bank in Korean won, but the bank funding that loan often carried dollar liabilities somewhere else on its balance sheet. A European bank buying emerging market bonds might hedge its currency risk using dollar swaps, which unintentionally creates structural demand for short-term dollar funding. The more interconnected global finance became, the more every institution's balance sheet quietly rotated toward the dollar. Why? Because it was the deepest, most elastic, and most trusted form of liquidity available. This created what we call a dollar funding gap. On one side of a bank's ledger, you have long-term assets denominated in various currencies, things like mortgages in euros, corporate loans in yen, or government bonds in pesos. On the other side, you have short-term liabilities, a significant portion of which are in dollars. This mismatch is the core of the problem. Banks need to constantly roll over their short-term dollar debts to fund their long-term assets. It is like trying to pay a 30-year mortgage with a weekly paycheck. You're fine as long as the paychecks keep coming. But if they stop, even for a week, the whole structure collapses. This continuous need to find new dollars to pay off old dollar debts is the essence of the global dollar funding race. It's a race that never ends. So where do these banks get their dollars? Their first stop is the interbank market, where banks with excess dollars lend to those who need them. But their main source is the commercial paper and repo markets. Commercial paper is essentially a short-term IOU issued by a bank, promising to pay back dollars in, say, 30 or 90 days. The repo market or repurchase market is even more critical. Here, a bank sells high-quality assets like U.S. Treasury bonds with an agreement to buy them back a short time later, often the very next day, at a slightly higher price. The difference in price is the interest on the loan. For decades, these markets were the silent, efficient engine of global finance, providing trillions of dollars in overnight liquidity. They worked so smoothly that most of the world never even knew they existed. But this smooth operation depends on one crucial ingredient: trust. Lenders in these markets need to believe that the borrowing bank is solid and will be able to repay its debt. This brings us to the financial crisis of 2008. When the U.S. subprime mortgage market imploded, that trust evaporated overnight. Suddenly, no one knew which banks were holding toxic assets. Lending in the commercial paper and repo markets froze solid. For European banks that had become heavily reliant on these markets for their dollar funding, it was a catastrophe. Their long-term assets were fine, but they couldn't get the short-term dollars needed to stay afloat. They were solvent, but illiquid, and in finance, being illiquid is often a death sentence. The global financial system seized up, not because of a lack of will, but because the plumbing of dollar funding had broken. The Federal Reserve had to step in with massive emergency swap lines, essentially lending dollars to other central banks around the world so they could, in turn, lend them to their domestic banks. It was a stark reminder that the dollar wasn't just America's currency, it was the world's financial operating system. And the chase for dollars has only intensified since then. Post-crisis regulations, like Basel III, were designed to make banks safer. They required banks to hold more high-quality liquid assets and reduce their reliance on unstable short-term funding. But in a strange twist, these rules actually increased the demand for the ultimate high-quality asset: U.S. Treasury bonds. And what do you need to buy U.S. Treasuries? Dollars. Furthermore, as the U.S. government runs large deficits, it issues more treasury bonds. Foreign institutions buy these bonds, which further cements the dollar's role as the world's primary reserve asset. This creates a self-reinforcing cycle. The more the world relies on the dollar system, the more it needs to acquire dollar assets, and the more it needs dollar funding to do so. Every global bank, whether in Frankfurt, Tokyo, or London, is forced to participate in this system. Their own profitability and survival depend on their ability to access deep and liquid dollar markets. Think of it this way: the global financial system is like a giant, complex machine, and the U.S. dollar is its lubricating oil. Even if a part of the machine is built in Germany and operates in China, it still needs that specific oil to function without grinding to a halt. When the supply of that oil is disrupted, the entire machine is at risk. This is why you see such intense focus on the Federal Reserve's policies, even from institutions that have no direct business in the United States. A small change in U.S. interest rates can send shockwaves through the global funding markets, making it more or less expensive for a bank in Zurich to get the dollars it needs to fund its loan book in Singapore. This isn't a choice, it's a structural reality. The desperation isn't about preference, it's about necessity. A European or Japanese bank could, in theory, fund its entire balance sheet in its home currency, but in doing so, it would be cutting itself off from the deepest, most liquid, and most trusted capital markets in the world. It would be at a significant competitive disadvantage. So, they play the game. They build their business models around a constant, structural need for dollars, hoping that the markets that provide them will always remain open and liquid. Then came the crises, and each one reinforced the same lesson. Back in 1982, when American countries defaulted on their loans, the immediate panic wasn't about the countries themselves. It was about the U.S. and European banks that had lent them all that money in dollars. The solution wasn't to fix local currencies, but to simply restructure the dollar debt, a clear sign of where the real power lay. Fast forward to 1997, and the Asian financial crisis taught us something even more dangerous. Entire nations, from Jakarta to Seoul, had borrowed heavily in dollars while their economies ran on local currency. It was a huge mismatch. When foreign investors got spooked and pulled their money out, the dollar skyrocketed. Suddenly, those dollar debts became impossible to repay, and economies suffocated almost overnight. This wasn't just bad luck. It was a direct result of a world where getting your hands on offshore dollars was the name of the game. Then, 2008 happened. The global financial crisis. The illusion that dollars were everywhere, for everyone, shattered completely. When Lehman Brothers collapsed, the biggest fear for global banks wasn't their losses on mortgages. It was losing access to the overnight dollar funding they needed to simply stay open. European banks, in particular, had built enormous portfolios of dollar assets, all financed with short-term loans. When that short-term funding market froze, the scramble for dollars became a matter of survival. This is when the U.S. Federal Reserve had to step in. They opened up what are called swap lines with other central banks around the world. In effect, the Fed became the lender of last resort not just for America, but for the entire planet. The world had woken up to a new reality. The dollar system was too big and too interconnected to fail, but it was also too big for any one country to truly control. Even after central banks pumped trillions into the system to calm things down, the underlying problem didn't go away. Dollar liabilities, meaning the amount of money owed in dollars, just kept growing. Emerging markets started hoarding dollar reserves to protect their own currencies. Big corporations issued bonds in dollars because it was cheaper. Banks created complex derivatives that all required dollars to back them up. Little by little, the entire world got tangled deeper and deeper into a system where any sign of stress, anywhere, immediately showed up as a desperate need for dollars. We saw it again in 2011 during the European sovereign debt crisis. The headlines were all about Greece defaulting, but behind the scenes, the real problem was that European banks held dollar assets financed by very fragile, short-term markets. When American money market funds got nervous and pulled their funding, it wasn't the value of the Greek drachma that moved first. It was the price of borrowing dollars. The system was communicating through the plumbing of finance, not through the news headlines. And then came 2020. The global pandemic shutdown was the ultimate stress test. And once again, where did the panic start? Not in the stock market. It started in the market for cross-border dollar swaps, the place where international banks borrow dollars from each other. The cost to get dollars exploded. In response, central banks had to reopen those swap lines on a scale we had never seen before. It was the final confirmation of what financial insiders had known for decades. The global financial system simply cannot function without constant, easy access to U.S. dollars. This is the structural trap, the one that no politician or central banker ever really talks about openly. The world didn't consciously choose the dollar. The world just grew into it, like a plant growing towards the only source of light. And now, banks everywhere in Tokyo, London, Paris, Sao Paulo, Dubai, their entire business model is wired into the system. For them, having access to dollar funding isn't a choice. It's like oxygen. It's built into the very bloodstream of their balance sheets. But something else happened as the system evolved. Chasing dollars stopped being just a reaction to a crisis. It became a core strategy. Banks learned how to use the availability of cheap dollars to boost their profits, manage their risks, and compete on a global scale. But in doing so, they also made themselves incredibly vulnerable to the very thing they were chasing. They exposed themselves to the exact funding pressures that ignite every crisis. And here's the quiet truth underneath it all. Global banks don't chase dollars because they love the U.S. economy, or because America is a superpower, or because the dollar is some kind of status symbol. They chase dollars because the system forces them to. It's a matter of survival. They do it because the amount of dollar debt in the world has grown much, much faster than the supply of safe dollar assets to back it. They do it because the offshore dollar market, the so-called Eurodollar market, operates outside of U.S. regulations. They do it because modern finance, with all its derivatives and hedging, demands constant settlement in dollars. And they do it because when it comes to money, Liquidity is king. And all liquidity, when you look at it on a global scale, eventually flows towards the deepest pool. Right now, and for the foreseeable future, that pool is the U.S. dollar funding market. Once you understand this, the pattern is impossible to miss. Every single global crisis of the last 40 years didn't start with fear or panic. It started with an imbalance in dollar funding. Every financial meltdown began as a quiet whisper in some obscure, offshore dollar market. Every small ripple only became a tidal wave after the dollar started to move. And the reason for this, as we're about to explore, isn't some historical accident. It's a result of systemic design, a design that nobody ever drew a blueprint for, but one that everyone in the world now depends on. There's a moment in every global funding cycle when the system quietly flips, and almost no one outside the deepest corridors of international banking feels it happen. Prices still look orderly, headlines still sound calm, central bankers still repeat their scripted reassurances. But inside the balance sheets of global banks, where all the complex parts intersect, something changes. A subtle shift, almost imperceptible to outsiders, begins to spread. And for the first time, the dollar is no longer just a currency. It becomes a constraint. The twist is this: the world's demand for dollars doesn't grow smoothly. It grows in waves, driven by incentives that erupt in silence. A change in hedging costs, a deterioration in collateral quality, a sudden drop in offshore liquidity, an unexpected tightening by U.S. money markets. These tiny pressure points, individually minor, collectively invisible, combine into a force powerful enough to rupture stability long before any crisis is acknowledged publicly. Most people believe global banks monitor their dollar needs through simple ratios or routine stress tests. But the reality is far more intricate. Their exposure breathes with the markets. A single change in volatility can increase margin requirements and force institutions across continents to seek more short-term dollar funding. A shift in interest rate differentials can raise the cost of hedging foreign assets, pushing banks toward alternative funding channels that depend even more heavily on offshore dollar liquidity. Even currency depreciation in an emerging market can destabilize the balance sheet of a bank in Europe or Japan, not because of direct losses, but because the derivative hedges tied to those currencies settle in dollars. This is the trap that global banks rarely articulate. Their dollar needs aren't static. They expand in moments of uncertainty and shrink only when markets are calm. But the world is rarely calm. The real twist, the one that insiders talk about only in the quietest tones, is that dollar funding stress doesn't begin with a shortage of dollars. It begins with a shortage of balance sheet capacity to intermediate those dollars. When risk rises, banks pull back not because they can't find dollars, but because they no longer want to lend their balance sheets to provide them. And in that instant, the entire global system experiences a liquidity shock that looks like a dollar shortage, but is, in fact, a structural withdrawal of willingness. This is why crises often appear so sudden. The system doesn't slowly degrade. It continues functioning smoothly until the moment balance sheet capacity tightens, and then the entire architecture pivots around a single axis: access to dollars. That pivot doesn't happen on the surface. It happens in the plumbing. Consider what happens behind closed doors at a major international bank when early signs emerge. Treasury desks begin monitoring basis spreads with a nervous precision. Margin teams recalculate exposures hourly. Funding desks test alternative markets like cross-currency swaps, FX swaps, and repo with increasing frequency. Collateral managers scrutinize whether certain securities might lose acceptability in stress conditions. And yet, to the outside world, nothing looks wrong. Even the bank's clients remain unaware. They see stable lending conditions, steady FX quotes, familiar credit lines, but inside the institution, the atmosphere shifts from routine to vigilant. The pivot becomes unmistakable when the cost of hedging foreign assets spikes. A Japanese bank holding U.S. Treasuries may suddenly find that the currency hedge wipes out the yield advantage, forcing it to seek cheaper funding or unwind the position altogether. A European bank financing dollar-denominated corporate loans might discover that rolling its short-term funding becomes slightly more expensive, putting pressure on its returns. These aren't dramatic events. They are basis point adjustments. But in a world tied together by trillions of dollars in cross-border claims, basis points carry the weight of tectonic plates. And then comes the moment when insiders realize something irreversible. The scramble for dollars has already begun. But it hasn't yet reached the surface. Funding desks whisper to each other. Swap line chatter increases. Large banks reduce the tenor of interbank lending. Repo markets start to differentiate more sharply between acceptable and less acceptable collateral. The system is inching toward stress, even as the public sees nothing. The twist is not that the world depends on the dollar. That part is known. The twist is that the world depends on dollar funding mechanisms that expand during calm periods and collapse during stress. The expansion is automatic. The contraction is violent. And because global banks structure their balance sheets on the assumption that dollar liquidity will always be accessible, they continually rebuild the foundation of the next crisis without even realizing it. By the time the public notices the symptoms, a surging dollar index, headlines about shortages, policymakers issuing reassurances, the pivot has already happened. The funding pressure has already spread through offshore markets. Global banks have already tightened their internal controls. And the world is already inside the early stages of a crisis no one will formally acknowledge for weeks. This is the moment where the story accelerates. Because now that the system has shifted, the mechanics underneath it, hidden, fragile, and deeply interconnected, begin to reveal their true consequence. To understand why global banks chase dollars with an almost obsessive persistence, you have to look beneath the surface of modern finance. You need to enter the unseen machinery, the deep, cross-border architecture where bank balance sheets interlock, where money moves through corridors invisible to the public, and where every major institution relies on a currency it doesn't control. This machinery isn't simple. It's not what you read about in textbooks. It's a recursive, self-reinforcing system. The deeper you look, the more you realize that global finance isn't just denominated in dollars. It's constructed around dollar liabilities that have to be renewed every single day. This creates a constant pressure system, forcing banks into a state of perpetual motion, always hunting for their next dollar. The first principle of this hidden world is simple, but incredibly dangerous. Global banks hold far more dollar assets than they have in dollar deposits. Think about it. They lend dollars, invest in dollar securities, use dollar derivatives, and clear dollar payments. But they fund all of this exposure through short-term markets that offer absolutely no guarantee of stability. This structural mismatch, long-term dollar assets versus short-term dollar liabilities, isn't an accident. It's a strategic choice made over decades of financial evolution. Why? Because dollar markets are deeper, dollar assets offer better returns, and dollar-based collateral is accepted everywhere. But every single one of these advantages comes with a hidden cost, a deep, structural dependence on constantly rolling over their dollar funding. The system forces banks to refinance day after day, and this constant need to refinance makes them incredibly sensitive to even the slightest tremor in global liquidity, long before the news or central bankers even acknowledge that something is wrong. The first layer of this mechanism is the FX swap market. This is the true heartbeat of global dollar demand. When a bank in Europe or Asia needs dollars, it doesn't fly someone to New York with a suitcase. It enters the FX swap market. They exchange their local currency, euros, yen, you name it, for dollars, with the promise to reverse the transaction later. This is the largest, most consistent source of cross-border dollar funding in the world. The price of this exchange, measured by something called the cross-currency basis, tells you more about global financial stress than any stock market index ever could. When the basis is near zero, everything is calm. But when it plunges into negative territory, it's a clear signal that a scramble for dollars is happening just beneath the surface. History is littered with examples. During the 2011 European debt crisis, the erupts basis collapsed, effectively taxing European banks just for needing dollars. In 2016, Japanese institutions, pressured by their own regulatory cycles, drove the JPY or USD basis sharply lower. And in March 2020, as global markets went into a free fall. Dislocations in the FX swap market were the earliest and clearest signal that the world had entered a full-blown funding panic. The pattern is always the same. As uncertainty rises, banks rush to secure dollars, which pushes up the cost of getting them. This reveals the stress long before it shows up in credit spreads or stock prices. Beneath the FX swaps, you have the repo market. This is the second pillar of the dollar funding architecture. Repo is often described as the safest form of borrowing. A bank pledges high-quality collateral, usually U.S. Treasuries, in exchange for short-term dollar loans. But this idea of safety is an illusion. It's entirely dependent on the acceptability of that collateral. When market volatility spikes or the quality of collateral is questioned, lenders react instantly. They demand larger haircuts, meaning they lend you less money against the same collateral. They shorten the loan maturities, and they narrow the list of what they'll even accept as collateral. A U.S. Treasury bond that was easy to finance yesterday might become difficult to fund today. A mortgage-backed security with the perfect AA rating might suddenly require a massive, punitive haircut. Even a tiny shift in how collateral is valued can have huge, cascading effects on a bank's ability to get funding. The fragility of the repo market has been exposed in every major crisis. In 2008, haircuts on supposedly safe securities soared as lenders fled from anything that wasn't pristine, top-tier government debt. In 2011, European banks faced a silent repricing of their collateral pools, forcing them into fire sales of their assets. And in 2020, the stress was so severe that repo rates spiked even though there was plenty of collateral around. The problem wasn't a shortage of collateral. It was a collapse in the willingness of dealers to use their own balance sheets to facilitate trades. The repo system matters because it's what transforms collateral into cash. And when that transformation becomes difficult or expensive, banks are left with only one choice. They have to sell assets. Selling drives prices down, which reduces the value of their remaining collateral, which tightens funding even further. It creates a reflexive, downward spiral that accelerates stress across the entire financial system. Then, sitting above the repo market, you have the world of short-term wholesale funding. This is a market built not on collateral, but on pure confidence. Here, banks issue things like commercial paper and certificates of deposit, or they borrow directly from other banks in the interbank market. These instruments rely entirely on trust. Trust that the borrower will be able to repay tomorrow. Trust that the system is stable enough that funding can be rolled over without any fear. But confidence evaporates much faster than collateral loses its value. In 2008, U.S. money market funds, a huge source of this funding, abruptly stopped lending to European banks. It wasn't because they doubted the euro. It was because they were afraid of their exposure to dollar assets that were being funded offshore. A funding freeze followed, leaving global banks completely stranded until central banks stepped in with massive liquidity lines. We saw similar dynamics play out again in 2011. In 2015, a strong dollar disrupted funding cycles for emerging markets. And in 2020, wholesale funding markets around the world collapsed within days. These markets show a brutal truth. Dollar funding is never guaranteed. It only exists as long as lenders believe the system will remain stable. And because that belief can vanish in an instant, banks can't really rely on wholesale funding for safety. They rely on it because they have no other choice. But perhaps the most underestimated and most powerful force in this entire dollar funding ecosystem is derivative margining. This is the quiet vacuum that can suck dollars out of global markets during times of stress. Banks all over the world trade trillions of dollars in derivative swaps, futures, options, all linked to interest rates, currencies, commodities, and stocks. These positions require margin payments. There's an initial margin when a trade is open. And then there's variation margin, which is paid daily as the prices of these contracts move. And here's the critical part. Variation margin is almost universally paid in U.S. dollars. This means that a spike in Japanese interest rate volatility can trigger a massive dollar margin call for a bank in Germany. A sharp move in oil prices can drain dollar liquidity from banks in Asia. A sudden drop in an emerging market currency can force banks worldwide to scramble for dollars, even if they don't hold any direct dollar assets. The margin system ties all global risk back into a single currency. In March 2020, central clearinghouses issued tens of billions of dollars in margin calls in just a few days. This triggered an emergency, worldwide demand for dollars. Banks that had plenty of their own local currency were still forced to rush into stressed dollar markets just to meet these obligations. Derivative margining is an amplifier of stress because it reacts instantly to volatility, while repo, FX swaps, and wholesale funding might tighten over hours or days. Margin calls tighten in minutes. So, when you put all of these pieces together, you see the true nature of the global dollar system. It's a complex, interconnected machine that breathes slowly and calmly when markets are quiet. But when volatility erupts, it gasps for air, creating a desperate, system-wide scramble for dollars that can bring the entire global economy to its knees. Companies in Japan, banks in Germany, governments in Brazil, they all need dollars to trade, invest, and pay off debts. The problem is, they don't have a magic dollar tree. They have to borrow them, mostly through short-term markets like FX swaps and repo. Think of an FX swap as a temporary currency exchange. A European bank might swap its euros for dollars today, promising to swap them back in a few months. It's a way to get dollars without actually selling their home currency. The repo market is similar, but instead of currency, it uses high-quality assets like government bonds as collateral for short-term dollar loans. These markets are the plumbing of the financial system, moving trillions of dollars around the globe every single day. They rely on one crucial ingredient: trust. As long as everyone believes they'll get their money back, the system works smoothly. But when that confidence wavers, the pipes start to freeze. Overlaying these market mechanics is a thick layer of regulation. After the 2008 crisis, rules like the liquidity coverage ratio and Basel capital requirements were put in place to make banks safer. These rules force banks to hold more stable funding and capital, which sounds great in theory. The goal was to reduce fragility. But here's the catch: these same rules can make things worse during a crisis. In normal times, banks push right up against these regulatory limits to maximize their profits. But when stress hits the market, the rules prevent them from stepping in and providing the liquidity the system desperately needs. For example, during the market turmoil in March 2020, regulations made it too expensive for big U.S. banks to participate in the repo market. They actually pulled back right when everyone needed them most. It wasn't until regulators offered temporary relief that the markets calmed down. So, the very rules designed to create stability can end up amplifying instability, creating a dangerous cycle where banks are forced to shrink when the system needs them to expand. This brings us to the central problem, what I call the global dollar liability pyramid. The numbers are staggering. Outside the United States, borrowers owe over $13 trillion. The value of dollar-linked derivatives is more than $65 trillion. Nearly 90% of all foreign exchange trades involve the dollar. What does this all mean? It means the rest of the world has a massive structural short position in dollars. They owe far more dollars than they actually hold. To stay afloat, they have to constantly roll over these debts, day after day, in markets that only function when things are calm. Imagine a mountain that keeps getting heavier during good times, but becomes incredibly unstable the moment the ground starts to shake. That's our global financial system. A bank in Korea financing its dollar loans is connected to a bank in France hedging its currency risk, which is connected to a bank in Brazil clearing derivatives, which is connected to a bank in London funding itself in the repo market. It's a tightly woven web. Stress in one corner of the world doesn't stay there. It instantly becomes everyone's problem. Now, let's add the human element: behavior. Banks don't wait for a crisis to be announced on the news. They act preemptively. The moment they see the slightest sign of trouble, a small shift in currency swap prices, A tiny increase in repo rates, they start hoarding dollars. They have to. It's a rational survival instinct for an individual bank. But when every bank does this at the same time, it becomes disastrous for the system as a whole. They collectively create the very dollar shortage they are afraid of. Demand for dollars skyrockets just as the supply of dollars dries up. It's a vicious feedback loop. Funding costs spike, institutions pull back, and markets get weaker. This volatility leads to more margin calls on derivatives, which tightens funding even more. So what looks like a dollar shortage is often a shortage of willingness, a collapse in the trust and balance sheet capacity that allows dollars to flow freely. Think of funding as oxygen. When banks sense the air is getting thin, they all start running for the exit at once. And once the stampede begins, it's almost impossible to stop. When you put all these pieces together, the reliance on FX swaps and repo, the constraints of regulation, the massive global dollar debt, and the preemptive behavior of banks, you see the full picture. The global dollar system isn't fragile because markets panic. Markets panic because the system itself is inherently fragile. A crisis doesn't begin with a big news event. It starts quietly, in the hidden plumbing of the financial system, when the cost of cross-border funding begins to creep up. It starts when lenders subtly step back. By the time the headlines declare a crisis, the silent scramble for dollars has already happened. So, here's the mechanism in a nutshell. Global banks build up huge dollar exposures, funding them through short-term markets. But these markets are fair weather friends. They vanish during volatility. This forces all these banks to compete for a shrinking pool of dollars at the exact moment when demand is exploding. This dynamic is the seed of every global financial crisis. It's not fear that causes the collapse. It's the structure. The entire world is built on the daily refinancing of debts in a currency that only one country controls, but that every country depends on. This is why funding stress always precedes a major market event. And it's why global banks are constantly chasing dollars, not because they want to, but because the system gives them no other choice. For them, constant motion is survival. Standing still means failure. Every major financial shock of the last few decades, from the Asian financial crisis to 2008, can be traced back to the same starting point. A moment when the world started needing dollars faster than the system could provide them. It begins in the most ordinary places, a technical spread between two rates widening just a little, a repo desk asking for a bit more collateral, a corporate treasurer mentioning that overnight funding feels just a little tighter there yesterday. These aren't dramatic signals. They're tiny distortions, whispers that most of us would never hear. But inside the world's largest banks, these whispers are like alarm bells. They trigger a deep, institutional memory of every time in history when liquidity didn't just shrink, it vanished. All at once. The global dollar system is a paradox. It's built on a currency that most of the world's banks don't control. These institutions, the very pillars of global finance, have to constantly borrow dollars to stay in business. They're refinancing trillions every single day, in markets that can evaporate the moment stress appears. The system only works as long as everyone unconsciously believes it will. But the moment you start consciously thinking about whether you'll have enough dollars tomorrow, the game has already changed. The dollar is stable until it isn't. It's available until everyone needs it at the same time. This is the fundamental contradiction that bankers live with every day. So when they sense even the slightest tightening, they don't wait. They start chasing dollars early and aggressively, and in doing so, they create the very scarcity they were afraid of, setting the stage for the next crisis. If you ever get the chance to listen to people who've spent their careers in global funding markets, you'll notice they talk about crises differently. They don't see them as sudden events. They describe them as pressure, slowly building and shifting from one balance sheet to another until something, somewhere, inevitably buckles. They know that a bank can sell assets. It can absorb losses. It can even raise new capital. But what it cannot do is wait for funding. If a bank loses its access to dollars, even for a few hours, everything else becomes irrelevant. That's why the insiders watch the signals the public ignores. They monitor the cost of hedging foreign exchange risk, They obsess over the behavior of overnight interest rates. They watch the early movements in cross-currency swaps. These are the tremors beneath the floorboards, the subtle signs that the foundations of the global financial system are starting to strain. The uncomfortable truth is that the next crisis won't look new. It will look hauntingly familiar. It will begin with that same invisible stress in offshore dollar markets, with liquidity providers quietly pulling back, and with institutions preparing for a storm before anyone else has even seen the clouds. And this time, the stakes are even higher. The world is more leveraged to the dollar than ever before. It's embedded in everything: global supply chains, energy contracts, emerging market debt, and a multi-trillion-dollar universe of derivatives. This means the early warning signs will appear even sooner, and the fallout could be even greater. The banks will feel the ground shift long before the markets do. And once that shift begins, it's almost impossible to stop with reassuring speeches or policy tweaks. What this reveals is a core truth about our financial world. We built a global system around a single currency, but then we distributed the responsibility for managing it across thousands of institutions that have to borrow it just to survive. This isn't a system designed for stability. It's a system designed for perpetual motion. And when the motion must never stop, even the smallest hesitation can become a source of massive systemic tension. So if you want to understand where future stress will come from, don't watch the stock market. Don't listen to government forecasts. Watch the places the system tries to hide its stress. The subtle tightening of offshore dollar funding, the changing quality of repo collateral, the widening of cross-currency basis spreads, the rise in margin calls on derivatives. These are the real warnings. These are the quiet signals that the world's most important financial engine is beginning to overheat. And here's the final truth, the one that's so often missed. The system doesn't warn loudly. It whispers. It shifts by basis points, not by headlines. By the time the world hears the noise, the real event, the silent part, has already happened. The banks that felt it first have already run for cover. Every crisis starts with the same pattern: a tightening you can't see unless you know exactly where to look. A pressure point that feels insignificant until it becomes the only thing that matters. A chase for dollars that begins as a precaution and ends as a desperate necessity. We think crises begin with fear, but they don't. They begin with funding. They begin with the tremor deep inside the machinery that holds our world together. And when that tremor returns, it won't announce itself. It will arrive quietly, as it always does, hitting the one weak spot that no system, no institution, and no nation has ever been able to escape: the demand for dollars.